I discovered a credit score loophole completely by accident, and it changed everything. The day I found it, my score jumped 89 points in just 30 days. But here's the crazy part. Banks actually don't want you to know this exists.
Because when you understand how this works, you stop being profitable to them.
Most people think credit scores are this mysterious, untouchable number. They treat it like some financial report card that only time can fix. But credit scores aren't actually measuring how responsible you are with money. They're measuring how profitable you are to lenders. That's the first thing banks hope you never figure out.
Let me show you exactly how the system actually works.
Your credit score is made up of 5 main factors. Payment history is 35%, amounts owed is 30%, and length of history is 15%.
New credit is 10%, and credit mix is the final 10%.
Now here's what nobody tells you about that 30% amounts owed category.
It's not about how much debt you have, it's about your credit utilization ratio.
This is the percentage of available credit you're actually using. Everyone says keep it under 30%, and that's where the trap begins. Because 30% isn't actually the magic number for a great score. People with scores above 800 average under 7% utilization. And here's the loophole. Most people calculate this completely wrong. They think utilization is calculated when they make purchases throughout the month. But credit bureaus only see what's reported on your statement date. So even if you pay in full every month, your score could be tanking.
Let me give you a real example that shows how broken this is.
Sarah has a credit card with a $10,000 limit. She spends $3,000 every month and pays it off in full before the due date.
She never pays interest, never carries a balance, perfect payment history.
But her credit score stays stuck in the low 700s. Why? Because her statement closes with that $3,000 balance showing. That's 30% utilization being reported to the bureaus every single month. Even though she pays it off, the damage is already done. Now here's the loophole Sarah discovered. She started making payments before her statement closing date. Not before the due date, before the statement even generates.
So instead of waiting until the bill comes, she pays early.
When her statement closes, it shows a $200 balance instead of $3,000. That drops her reported utilization from 30% down to 2%. Within 60 days, her score jumped from 720 to 791. Same spending habits, same income, same payment behavior, different timing. But here's why banks absolutely hate when you do this. When you carry a statement balance, even if you pay in full, you look riskier. Riskier customers get offered higher interest rates on loans and mortgages. A 720 score might get you 7% on a mortgage.
But a 790 score gets you 6.2% on that same mortgage.
On a $400,000 loan, that's $92,000 saved over 30 years. Banks lose that $92,000 in interest income when you optimize your utilization. Banks lose that $92,000 in interest income when you optimize your utilization. Now let me show you the second part of this loophole.
It's called utilization stacking, and it's completely legal.
Most people have 1 or 2 credit cards and try to keep utilization low. But high-score players do something totally different.
They increase their total available credit without increasing spending.
Let's say you have one card with a $5,000 limit. You spend $1,000 monthly, which is 20% utilization. If you open a second card with a $5,000 limit but don't use it much, something magical happens. Now you have $10,000 total available credit.
That same $1,000 in spending is suddenly only 10% utilization.
Your score goes up, even though your behavior didn't change at all.
Here's the exact strategy people with 800+ scores actually use.
They keep 3 to 5 credit cards open with high total limits.
Actually use. They use 1 or 2 cards for regular spending. The others just sit in a drawer, aging beautifully and providing available credit. Then they make payments twice a month, mid-cycle and before the statement date.
This keeps their reported utilization under 5% at all times. But there's one mistake that ruins this entire strategy.
Closing old credit cards to simplify your finances.
When you close a card, you lose that available credit permanently.
Your utilization rate shoots up and your average account age drops. It's a critical negative impact, a double hit that really hurts.
Both of those changes tank your score fast.
I've seen people lose 40 points just from closing one old card.
So here's your exact action plan to use this loophole starting today.
Step 1. Find out when your statement closing date is for each card. Call your card company or check your online account. It's listed there.
Step 2. Make a payment 5 days before that closing date.
Pay enough to bring your balance under 7% of your credit limit.
Step 3.
Consider requesting a credit limit increase on your existing cards. This increases available credit without opening new accounts. Step 4. If you're ready, open one additional credit card strategically.
Use it for small recurring bills, then automate payments before the statement closes. Within 90 days, you'll see your score climb in ways you didn't think possible. The credit system isn't fair, but now you know exactly how to work it.
Subscribe if this changed how you see credit scores, because most people never learn this.